Japan quietly shifts its auto supply chain out of North America, forging new alliances with the EU and ASEAN to safeguard its car industry. Are American consumers unknowingly paying the price for an increasingly complex trade confrontation? On March 19, 2025, the U.S. reimposed tariffs of up to 25% on vehicles imported from Canada and Mexico, key manufacturing hubs for Japanese automakers like Toyota, Honda, and Nissan. Popular models like the Toyota Corolla, Honda CR-V, and Nissan Sentra are particularly affected due to their North American assembly origins. As a result, prices of Japanese cars have surged by $1,500 to $3,000 per unit, while wait times have extended by 2 to 4 weeks at dealerships. Inventory shortages are being reported nationwide. Consumers are losing access to affordable, fuel-efficient models, like the Toyota Prius and Honda Civic, long-standing favorites in the U.S. market. Toyota and Honda shares dropped by 1.7% and 1.3% respectively on the Tokyo Stock Exchange, reflecting investor concerns. With over 35% of the U.S. passenger vehicle market held by Japanese brands, this policy shift risks backfiring. American cars, mostly trucks and large SUVs, cannot effectively replace these compact imports, leading to higher maintenance and fuel costs for the average U.S. household. Instead of direct confrontation, Japanese automakers are making strategic shifts. Toyota has announced a $300 million investment to expand hybrid engine production within Japan, aiming to serve global markets less dependent on U.S. logistics. Honda is reallocating 15% of its production from Mexico to Thailand, increasing Thai output by 20%. Nissan, meanwhile, has introduced a compact EV priced at $18,000 to $20,000, 25% cheaper than the U.S. average electric vehicle. These moves aim to shield production from U.S. trade volatility while enhancing competitiveness. In the long run, American consumers may benefit from more affordable, efficient Japanese EVs and hybrids, even if initially produced farther from U.S. soil. Pressure may also mount on U.S. automakers to reduce prices and innovate more rapidly. To further reduce reliance on the USA, Japanese firms are shifting production to Southeast Asia. Toyota is boosting its Thai factory's output by 40,000 vehicles annually, while Nissan is investing an additional $200 million in its Indonesian facilities. Vietnam, notably, has seen a 30% increase in orders for Japanese auto parts in Q1 2025. These countries offer lower labor costs and benefit from regional trade agreements, ensuring more stable production environments. For American consumers, this may eventually stabilize vehicle prices as the supply base diversifies. However, in the short term, delivery delays are expected as logistics routes are adjusted. In a more systemic response, the Japanese government has reduced its holdings of U.S. Treasury bonds, down from 16.3% to 14.7% of its foreign reserves, signaling waning confidence in U.S. economic policy. Simultaneously, Tokyo is accelerating trade pacts with the EU and ASEAN, with a focus on clean energy and electric vehicles. This policy shift could heighten financial risk for the U.S., potentially affecting currency stability and inflation. Yet for consumers, it may also expand global options for high-tech, eco-friendly Japanese vehicles, as manufacturers align with international standards and supply chains. U.S. tariffs rattle Japanese car market, pushing prices higher and causing widespread supply shortages. Why can a single tax policy place such pressure on American consumers? The United States has recently imposed a 25% tariff on imported vehicles from Mexico, a country that accounts for 35% of Japan's vehicle exports to the U.S., equivalent to nearly 2 million units per year. Toyota, Honda, Nissan, Mazda, and Japan, the largest exporter of automobiles into the United States, is now directly impacted by this new policy. Popular models assembled in Mexico, such as the Civic, Sentra, and Tacoma, are now at risk of price increases, ranging from $2,000 USD to $5,000 USD per vehicle, according to Edmunds. American consumers may lose access to Japanese vehicles known for their fuel efficiency, reliability, and affordability, a development that particularly affects first-time car buyers and middle-income households. While the tariff policy is intended to support domestic manufacturing, it also disrupts the Japan-Mexico-US supply chain, shifting the financial burden to consumers. In response to the recent US tariff measures, Japanese automakers are undertaking significant restructuring of their supply chains, a necessary shift, the one that is resulting in noticeable disruptions for everyday consumers. Honda is relocating production of the Civic from Mexico to the state of Indiana, investing $700 million USD in the process. Nissan has suspended orders for the Kicks and Sentra models assembled in Mexico, affecting up to 30,000 pending deliveries. Meanwhile, Mazda has accepted a loss of $100 million USD in the first quarter of 2025 to maintain vehicle prices and retain its customer base amid a volatile market. Manufacturers are also gradually moving production to the United States, Southeast Asia, and South America. However, this shift has led to the temporary disappearance of many vehicles priced under $25,000 USD, a category especially important to first-time car buyers and individuals relying on affordable transportation for work. The average wait time for vehicle delivery has extended to between 3 and 6 months, creating challenges for users who depend on personal vehicles for daily needs and professional obligations. The reduced availability of new vehicles has led to a sharp increase in the used car market, reflecting the supply-demand imbalance triggered by the recent tariff shock and placing a clear financial strain on average consumers, many of whom now find it difficult to access both new and used vehicles. Prices for pre-owned Japanese cars have increased by 12 to 20%. For example, the price of a 2021 Civic has risen from $19,000 USD to $22,500 USD, according to Kelley Blue Book, April 2025. Dealerships are shifting focus to used vehicles in an effort to maintain sales volume. At the same time, however, banks have tightened credit conditions. Auto loan approval rates have declined from 78% to just 62%, and rising interest rates mean higher down payment requirements and reduced loan limits. As a result, many consumers have found themselves turning to domestic models, lower-priced electric vehicles, or even rental options, even if these choices do not align with their original preferences. A shift in long-established car buying habits. Facing the risk of extended tariffs, Japanese car dealerships and businesses operating in the United States are collectively scaling back expenditures to stay afloat. More than 50% of Japanese dealerships have reduced staffing or temporarily closed showrooms, according to data from NADA, April 2025. After-sale services, including maintenance and repair, have also been affected due to shortages of parts and skilled labor, making it increasingly difficult for customers to obtain timely service, particularly for imported vehicles. According to Nikkei Asia, the Japanese government is currently considering trade negotiations with the United States and weighing potential countermeasures, as projected losses could exceed 1.5 billion USD per quarter if the tariffs remain in place. Consumer confidence is beginning to erode. A growing number of buyers are turning to domestic electric vehicles, Chinese models, or opting for car rental instead of ownership, seeking to avoid future risks related to rising prices and complex maintenance. China has made unexpected progress in semiconductor manufacturing, producing millions of advanced chips. Without relying on Western equipment, What is truly unfolding behind this strategic leap? In the face of tightened export controls on lithography equipment from the Netherlands and Taiwan, China has shifted its strategy, focusing on domestic semiconductor development. Between 2022 and 2024, China launched Phase 3 of its National Integrated Circuit Industry Investment Fund, with a total capital of 344 billion yuan, approximately USD 47.5 billion. The initiative aims to support chipmakers and related equipment manufacturers, strengthening the foundation of China's domestic semiconductor industry. To build technical capacity, tens of thousands of engineers have been recruited, many from major firms such as Huawei and SMIC. Meanwhile, patent filings in the semiconductor sector have seen a notable increase, reflecting strong investment in innovation and research. Data from China's General Administration of Customs reveals that in 2023, the value of integrated circuit imports declined by 10.8%, with import volumes down 15.4% compared to the previous year. Chinese companies have made headway in lithography equipment development, with the domestic sector projected to account for over 18% of the global market share in 2024. In March 2025, Shenzhen-based Sai Carrier announced the development of a customized deep ultraviolet (DUV) lithography technology, enabling the production of sub-7 nanometer chips without relying on extreme ultraviolet EUV systems. This innovation uses multi-layer patterning and AI-driven process optimization to enhance efficiency and reduce production costs. In Q1 2025, China manufactured approximately 2.3 million 7-nanometer chips, marking a major milestone in its push for a self-reliant semiconductor supply chain. Back in 2023, Huawei released the Mate 60 Pro, powered by the domestically produced Kirin 9000's chip, built using DUV technology. SMIC is currently testing 5-nanometer production processes and aims to reach 3-nanometer capabilities soon, leveraging quad patterning techniques and AI optimization to overcome current equipment constraints. ASML, the world's leading lithography equipment supplier, reported that sales in China accounted for 27% of its total system revenue in Q1 2025. Meanwhile, NVIDIA stated that newly imposed U.S. export restrictions on its H20 AI chips could result in an estimated $5.5 billion revenue loss, citing limited access to the Chinese market, one of the company's largest. According to a report by SEMI, China is projected to remain the world's top investor in semiconductor manufacturing equipment. Surpassing traditional industry leaders like Taiwan and South Korea, China is also expanding production of mature node chips, which are expected to account for roughly 28% of global supply by 2025. This surge in domestic output has sent ripple effects across the global tech sector, particularly impacting American firms like NVIDIA. In parallel, China has adjusted its trade policies, imposing tariffs on imported semiconductors from the United States, while exempting those manufactured in Taiwan and South Korea. This approach aims to mitigate disruptions in global supply chains and maintain cooperative trade relations with key partners. Former President Donald Trump's announcement of a new 25% tariff on imported cars and auto parts has triggered a rapid series of factory shutdowns, mass layoffs, and surging vehicle prices. As the ripple effects spread across the economy, many Americans are left wondering, how much longer will they bear the cost? Just days after Donald Trump unveiled the 25% tariff on April 18, 2025, Stellantis, the parent company of Jeep, Dodge, Ram, and Chrysler, suspended operations at several plants and announced large-scale layoffs. In the U.S., 900 workers were laid off. In Canada, the Windsor plant, which builds the Chrysler Pacifica and Voyager, cut 4,500 jobs. In Mexico, the Toluca facility, responsible for the Jeep Compass and Dodge Journey, shed 2,500 positions. In total, nearly 7,000 jobs were lost across North America within just 72 hours of the tariff decision, according to Bloomberg, April 20th, 2025. The financial impact is just as severe. Stellantis alone could face up to $41.9 billion in additional production costs. Flagship models like the Chrysler Pacifica, once starting at $38,000, may see price increases of $3,000 to $5,000, driven by part shortages and rising input costs. For American consumers, especially middle-class families, the spike in prices following job losses creates a dual crisis. One Michigan worker told Reuters, April 19, 2025, "We get the idea of bringing jobs back, but now we can't even afford the cars anymore." Once praised for its cost-efficient cross-border production system, Stellantis now finds that same structure breaking under pressure. Ram engines built in Mexico can no longer reach Michigan. Jeep is short on Canadian chips. Steel and transmission prices are surging, leaving Dodge struggling to maintain production. At the Sterling Heights plant in Michigan, Ram 1500 assembly lines have halted entirely. Across the U.S., dealerships from California to Texas are reporting empty showrooms. A Dallas-based dealer told CNBC, April 20, 2025, that customers now wait at least 6 weeks for delivery, often paying $1,500 to $2,000 more due to shortages. Budget-friendly models like the Jeep Compass, once priced under $30,000, are now either delayed or out of stock. Auto forums on Reddit are filled with frustration. There are no more cheap American cars, just expensive ones we can't get. The idea of relocating auto production entirely back to the U.S., long championed by Donald Trump, now faces harsh economic reality. According to Financial Times, April 21, 2025, U.S. labor costs are double those in Mexico, and building new factories could take 3 to 5 years and billions in infrastructure investment. Should Stellantis fully localize its operations, vehicle prices could rise by $4,000 to $6,000 per unit due to increased labor, materials, and logistics costs. With inflation and interest rates still elevated, American consumers, particularly middle-income groups like farmers and construction workers, stand to lose the most. Stellantis is attempting a hybrid survival strategy, accelerating U.S.-assembled electric and hybrid vehicles such as the Jeep Wagoneer SEV, Dodge Charger EV, and Ram Hybrid, while negotiating with domestic suppliers to reduce reliance on imports. Yet analysts warn that even these made-in-USA models are unlikely to return to pre-tariff pricing. As a result, many Americans now face a double blow: lost jobs and lost access to the affordable vehicles that once symbolized U.S. auto industry strength. U.S. imposes a 145% tariff on Chinese goods, shaking world's markets and revealing risky economic ambitions. The 145% tariff recently imposed by the United States on Chinese goods hasn't just rocked global markets, it's sparked big questions about Washington's new economic strategy. Is this truly just a tariff decision, or the opening move in a much larger economic showdown? It confirms total tariff rate on Chinese goods reaches 145%. The U.S. government has officially confirmed that the total tariff rate on certain imports from China has reached 145%, including a previously established 20% and a newly added 125%. According to a statement from the White House, this move is part of ongoing efforts to recalibrate the trade balance and address concerns surrounding industrial policy and economic security. Following the announcement, U.S. financial markets reacted noticeably. The Dow Jones Industrial Average fell by 3.4%. The S&P 500 declined by 4.2%, and the Nasdaq dropped 5%. These shifts reflect growing investor caution amid expectations of higher import costs, which could weigh on corporate earnings and dampen consumer outlook. Following a strong rally in early April, the U.S. stock market has experienced a downturn after news emerged that the U.S. government would impose a 145% import tariff on Chinese goods, specifically since April 2nd, when former President Donald Trump announced the tariff hike plan. The S&P 500 index has dropped approximately 6%, despite a session where it had gained over 9% shortly thereafter. In the trading session following the announcement of an additional 125% tariff, bringing the total tariff level to 145%, the Dow Jones Industrial Average fell by 1,700 points, around 4.14%. The Nasdaq declined by 5.75%, and the S&P 500 lost nearly 5%. Many experts believe that the high tariff levels have heightened concerns over import costs, directly impacting corporate profitability. Investor sentiment has also been affected by the lack of clarity surrounding trade policy direction, prompting more cautious behavior. The movement of capital away from equities towards safe haven assets, such as gold and bonds, highlights the increasingly defensive posture of the market. Bond market, according to former U.S. Treasury Secretary Janet Yellen, former President Donald Trump's decision to delay the imposition of tariffs on Chinese goods for 90 days reflects pressure from financial markets, particularly the U.S. government bond market. Following the announcement of the 145% tariff rate, the yield on 10-year U.S. Treasury bonds surpassed 4.4%. Rising sharply from around 4.1% in early March, this surge in yields was largely driven by a wave of investor sell-offs, which caused a significant drop in bond prices, a signal of growing uncertainty surrounding traditional safe haven assets. This development is regarded as a warning sign for the U.S. administration, as a continued decline in bond prices could raise government borrowing costs and potentially impact the standing of the U.S. dollar in international markets. While the White House has stated that the temporary delay aligns with its original plan, many financial experts believe the market's strong reaction compelled the administration to postpone full implementation of the new tariff package in the short term in order to ease systemic pressure. Small and medium-sized enterprises. According to expert Zongyuan Zoe Liu of the Council on Foreign Relations, CFR, the United States' decision to impose a total tariff of 145% on Chinese goods may have far-reaching effects on small and medium-sized enterprises, a sector that accounts for approximately 80% of China's export value and between 70 to 80% of employment in its manufacturing industry. These SMEs primarily operate in low-margin sectors, such as electronics, textiles, auto parts, and household appliances, and rely heavily on access to the U.S. market. The high tariff rate undermines the price competitiveness of Chinese goods, leading to canceled orders and reduced export volumes. According to data from China's Customs Authority, exports to the U.S. in the first quarter of 2025 declined by 8.6% compared to the same period last year, though marking the steepest drop since the COVID-19 pandemic. According to Zongyuan Zoe Liu of the Council on Foreign Relations, CFR, the U.S. policy proposal known as the Mar-a-Lago Accord, named after former President Donald Trump's resort, could have concerning economic consequences if implemented. Under this framework, the United States seeks to simultaneously achieve three major objectives. 1. Systematically devalue the U.S. dollar in order to boost exports and enhance the competitiveness of American goods in global markets. 2. Maintain the U.S. dollar's global dominance as the primary reserve currency in the international financial system. 3. Transition the U.S. from a trade deficit to a trade surplus economy, while also calling on allies to contribute more to regional security costs. However, LIU notes that the aim of devaluing the dollar to support exports, while preserving a strong dollar to safeguard its global position, presents a fundamental policy contradiction. Historical experience from the 1985 Plaza Accord shows that currency realignment can create short-term advantages, but often leads to financial instability. Moreover, the U.S. has consistently run trade deficits since the 1970s. In 2024 alone, the trade deficit stood at approximately $773 billion, according to the U.S. Bureau of Economic Analysis, BEA, reflecting the persistent nature of the imbalance. Despite previous policy efforts, if the Mar-a-Lago Accord is implemented without coordination from major economies such as China, Japan, or the European Union, all of which hold significant amounts of U.S. Treasury bonds, confidence in the U.S. dollar could be weakened, potentially leading to instability across the global financial system.